Right, guys, let's kick off. Thank you everybody for joining us. No, it's a public holiday tomorrow, so generally a bit of a lazy day before the public holiday. So thank you very much for joining us. I trust that the presentation will be enlightening and worth your while. Just to quickly go through in terms of what we're going to be talking about today. We've obviously been through a very volatile market, bond market specifically, and a lot of the income funds in the industry have been hit quite hard. Arno's going to talk through some of that, kind of what we've been through, and kind of what to expect from the bond market going forward. Arno's also going to touch on our two income solutions, our high yield fund and our flexible income fund. And really kind of how to position the two. We get a lot of questions all the time around which fund to use when and for which clients, etc. So we're going to be talking a little bit around how to position the two funds in these markets, and really how best to use these two portfolios or these two solutions in terms of helping you navigate through these turbulent times. So Arno will touch on some of that, and then he'll talk a little bit around the team. We've had a couple of new joiners into the specifically on the income side of our business. So Arno can touch on a little bit of that, and then really what to expect from the bond market and our portfolios going forward over the next 12 months. So it should be a good presentation. Looking forward to it. Thank you again for joining us. For those of you that are collecting CPD points, please stay online till the end to be able to get to CPD points. There was a question in terms of, will we be recording the session? Yes, we will, and we will be sending through the recording to all participants after the presentation. If there are any questions, please just include them in the chat, and then at the end of the presentation, we'll deal with as many as we can, and we'll try to conclude within the time limit by 11 o'clock. Thank you very much. Enjoy. Over to you, Arno.
Great, thanks, Mart. Good morning, everybody. Thanks for joining us. I was actually going to, I did see one of the questions that popped up, Mr. Cranston. You did actually give away your age and mine probably as well by referring it to as overhead slides. That goes back to many, many years ago when we stopped using overhead slides. PowerPoint it is these days. But yes, the slides will be available to everybody. And I'm going to jump straight in. I think Martin has touched on essentially the volatility that we have been dealing with. And, if I sort of use one measure of volatility, it's actually what we would term the VIX index, which is sort of readily available, a measure of market volatility. You can see through times that this index, is volatile. So volatility is volatile in itself. And but you can see that there's some periods where I've highlighted in the blue where it remains elevated. Market volatility remains elevated for quite lengthy periods of time. The red line's a moving average, which probably, if I then sort of use it as a rule, when it's above 20, it tells you that there are some transitions going through markets. And if you look at these periods in particular, we could sort of almost understand with hindsight what was going on. So when you had this period of heightened volatility in the late 90s and early 2000s, we know what was happening. It was essentially the beginning of the tech industry, if you want to put it like that in a sense, the tech bubble. And we know that what came after that, yes, the bubble burst, but if you had stuck around, you know what sort of you got in the end with hindsight. And then 2008 global financial crisis, again, a very sharp period of volatility. And again, I think, it set the scene then for these sort of ultra low interest rates and even negative bond yields that we sort of had in the sort of again, between probably around about 2010, around about 2020 odd. And then we've had sort of the most recent one that we sort of have at the moment, which is the actual COVID crisis. And then, of course, the post-COVID crisis, which we can probably typify with, being higher inflation. I won't go into the detail of it, but I think suffice to sort of, have it that there are these periods where you have heightened volatility and it is related to the uncertainty, and it sets the scene then for almost sort of what comes next. So if I look at each of these periods and sort of look at what did the bond market do, what did the equity markets do, if I look at that 1998 to 2003 period, you can see on the top panel the S&P 500, you had these periods of very, very big shifts in market valuations. Again, the tech bubble bursting in 2000, 2001 in particular, 49% from the top to the bottom, pretty severe stuff. But again, if you'd sort of if you were able to get in the bottom and set the scene for what came for the next couple of years. But again, we're not going to sort of touch on that today. And then the bond market at the bottom, again, you can see some of these shifts in terms of bond yields in 1998. A very big move, over 2.5% in the US 10-year bond yield. These are extreme moves, given the levels. And again, I haven't highlighted the down moves. Those are the positive moves. I'm more highlighting the risk and the sense of volatility in these periods. So you do get very, very significant shifts. And again, around the 2008 global financial crisis, also a 52% down, 16, 17%. So you get these very big swings. And then again, similarly in the bond space as well, again, 2% swings in yields. These are, if you think about what the duration of a US 10-year bond is, these are significant downward shifts in these periods on transition. And again, I think probably more recently, which we'd all be sort of aware of, the COVID crash, then the post-COVID recovery, which astounded everybody in terms of the length of that unbeaten run. And then again, more recently, as central banks responded, you saw big shifts downwards. And again, similarly on the bond market, more up than down in terms of these shifts. And I think if you had to ask me, if we know what came after the tech bubble bursting, we know what came after the 2008 global financial crisis. And the question would be, what comes after this, let's call it post-COVID crisis? And I think this bottom panel probably gives you an inkling as to what it is, which is, significant shifts upwards in interest rates, and more sustained and higher interest rates probably is what we're going to be dealing with. And we're not going to be necessarily returning back to these zero interest rate type of environment. So that is a significant shift. And that shift, as it takes hold, is most likely to lead to more volatility, in particular on the bond market side, as on the equity market side of things. So I think, the lesson learned from these sort of macro transitions, is a very simple one in a sense, which is that, expect to see significant, cross asset class volatility. And, I put it in plain English, like really big swings in markets. So, if you're an income investor, then I suppose, the question would be, what do you do as an income investor if you're faced with, if we park the equity market aside and say, okay, bond market, we're going to have these big shifts. How do we approach this? What's the strategy that we should be following? And I've highlighted here, here's one index with low volatility, almost no volatility. This is the STEFI index for South Africa. So it's the short-term fixed interest index. It's the overall index. So essentially, it's like a money market type of investment. And you could say, well, this is one option. It's always going up, no volatility. That's one option, I suppose, that you could look at. Unfortunately, I suppose what you'd be looking at, though, is that you're only getting a 6.3% return over this 10-year period that I've used over the last 10 years. And of course, the first thing you've got to remember is, are you beating inflation? So you are beating inflation with no volatility. So in a South African context, it has been possible over a long period of time to beat inflation consistently by about 1%. But I recognize that perhaps for most of you that that's not going to be enough. So certainly from an income perspective, you probably want to sort of look beyond that. But if I sort of now position this, if you look at the STEFI on the bottom, there's that sort of 10-year sort of return. And then if you look at equities, the all-share total return index, including dividends, in other words, with that significant volatility in the equity space, and yes, it's beaten it by a fairly impressive margin. But I suppose the question would be the volatility that you've experienced in that equity space. Is that if that's the outer boundary of your investment possibility or investment universe, where do you want to position yourself between these two? I think that's really the key here. Again, if I can just highlight here in particular in the South African context, right? So this is very particular to the South African context, is that in this particular period, up until, sort of 2020, the equity market didn't deliver the sort of returns that you would want to see. And I mean, only just sort of breaking loose of the STEFI index over the last essentially 2 to 3 years in the post-COVID recovery. So again, I think we all understand, investing into this sort of asset class spread, I suppose, does deliver in the long run, does deliver you the returns, but there's always that significant risk in a South African context that you might only just break even. Or in fact, in the COVID side of things, you'd actually were below the cash. So the question would be somewhere between cash is king and the far right of equity returns. You probably want to be positioning yourself. And if you look at the volatility of these two, you can see essentially the volatility between the top panel, which is the average volatility of the all share index, and then the bottom one. It looks volatile, but if you look at the scale on the right, pretty much close to zero volatility. So all share index average volatility 15.5, STEFI naught, just above naught. So then we sort of say, well, maybe we want to be somewhere in the middle. And this is the all bond index. So now we're sort of shifting closer towards pure income investing. And you can see the average volatility there is around about 6%. So I think that probably then positions us in that space in terms of where we want to be. And it gives you some inkling as to when you go into, if you are an income investor and you're going into a bond market, your average volatility is 6%. So if on a normal day, we sort of look out and we say, what is the average yield at the moment of government bonds? Your return over time is going to be around about 6% around that. So if we look at current bond yields, 11 to 12%, you can add and subtract that 6%, gives you the range of returns. Well, that's the experience over the last number of years. And that just helps you to understand the positioning as far as the volatility that we've seen in the bond market so far. The context that we're dealing with then really has been these three things, which is we know about the inflation story. It's been sticky, and it is a global phenomenon. Triggered by the COVID responses and then the subsequent delayed response from the central banks, as well as the fiscal stimulus that we saw from governments around the world in response to COVID. And then there's been this very anemic, growth recovery. And there's this overhang at the moment of a recession, in particular in the US, when you look at the inverted yield curve and so forth, that is, essentially talking that story. But again, I suppose it's been a surprise how long it's taken for, that recession to arrive in the US. The numbers have basically been a lot more robust than what has generally been expected by the market. And certainly from the labor market perspective, the US labor market is still looking very, very healthy at this point in time. I think the headwinds that we're facing in the bond market really then sort of, headwinds to stability, apart from the fact that you've got the sticky inflation, really has been, remember at the top end of a cycle, of an interest rate cycle, you generally see the cracks starting to show. You see credit rating downgrades. We know in South Africa, from a sovereign perspective, we've seen South Africa being consistently downgraded. I'll show you a chart a little later on that. And then you have these shifts in monetary policy at the top of the cycle. You've seen in the South African context that the SARB has basically started communicating that we are approaching the top. They always leave the door open for further hikes. Similarly in the Fed, where again, there's expectations growing that maybe they haven't reached the top yet. And the possibility is always there that those shifts in terms of the communication, or that the actual shift in terms of either hiking too late in the cycle, or they stop too soon. So there's all these sorts of things that are at play. And the little picture I put there, just to remind everybody that there's these black swan events. If we think about this, the sorts of things that happen at the top end of the cycle, where you don't see it almost coming in a way. If I think about Silicon Valley Bank earlier this year, Credit Suisse falling over, shifts in Japan, etc., etc. So these are the sorts of things that happen. And what it speaks to then is two things, I suppose, is a confirmation or an affirmation of heightened volatility from these sorts of events, over and above the macro transition side of things. And then it also speaks to the fact that essentially you have to price in significant risk premium into your asset classes in order to compensate for these things. And so the question then would be, as an income investor, how do we steer through these sorts of things. So if we look at the Fed's response as the global sort of liquidity provider, if you want to put it like that, you can see essentially where they've got to in terms of their rates on the right there, above 5%, heading towards 6% potentially is what the markets are debating. And if you think about it, the last time we were at these sorts of levels really goes back to pre-global financial crisis. And bear in mind, remember the global financial crisis, 2008, the precursor to that was that upcycle in interest rates. So again, I'm not saying that we are necessarily going into a similar sort of crisis. This is the point about it. That was also essentially, there were elements of a black swan side of things. And with hindsight, you could always disentangle what was going on and look at the mortgage loan market and so forth. But again, I think I just wanted to highlight again that at the top end of the interest rate cycle, it generally is a fairly dangerous position in time as far as investment markets are concerned. So what we did see, I touched on credit rating downgrades, and a week or so back, you might have seen that the US government or sovereign was downgraded from AAA status to AA+. And you could sort of say, see, it's not just South Africa that gets downgraded. Even the best take a tumble sometimes. And the question would be, does it really matter? In the case of the US, being the most liquid capital provider and money market in the world, if you want to put it like that. And if you look at the CDS spread, and CDS really is the credit default swap spread, and it's an indicator of default essentially. So when it's at a very low level, then essentially what it's saying is your risk of default is pretty low. And you can see there have been a few spikes in the past. It's related essentially, and more recently earlier this year, where it spiked and was the highest since the global financial crisis. So if you look at 2008, and we know that that was a systemic issue, and you look at the level of CDS spreads, and then you saw what happened earlier this year, and you could sort of say, well, we had a global financial crisis 2008, risk of default looked to be fairly contained. What happened in 2023? Well, it was that debt ceiling negotiation between essentially in particular in the Senate side of things, of raising that. Otherwise, there was the potential for default. It would have been a technical default, but still a default. But I think, most recently with the downgrade, that last little bit at the end on the bottom right, post that, there's been no move. So what the market's saying is our downgrade of the US to AA+ is really sort of, it doesn't matter. And nothing's really sort of changed as far as the bond market is concerned. I think the one other angle in terms of these risks that are out there, I want you to highlight was, you might have seen sort of over the last week, some news coming out of Japan, in particular, a shift upwards as far as their bond yields are concerned. And if I go back many years, there have been market commentators that have been calling a short on Japanese bonds for many, many years. And it's sort of a bit of a as you would call it, a widowmaker trade, because they just did not go up. And now we've seen a shift upwards in bond yields. The Bank of Japan has raised their target level or sort of band up to 1%. And I think why this counts is if you look at the panel on the left, which is your debt to GDP ratios, and you can see Japan sitting at the second top at over 250% debt to GDP. Bear in mind, as a comparison, South Africa sits at probably somewhere between 75 to 80% expected debt to GDP ratio. And then you sort of ask the question around affordability. And the reason why a country like a United States sitting there at 134% debt to GDP is a AA+, and South Africa with a 75% debt to GDP ratio sits at a BB- is precisely because of the cost of the debt. So in the case of Japan, the fact that they have this debt burden hasn't mattered because their bond yields or cost of their debt has been so low. But as this starts shifting up, does this cause an earthquake in global financial markets going forward? That is something which we are going to have to watch going forward. Essentially, it can put Japan into quite a tricky scenario. Is there contagion? At the moment, it appears as if it's fairly well contained and not going to be a broader contagion into global bond markets. But again, I think this is something which we're going to have to watch very, very carefully over probably the course of the next couple of years. And again, if one looks at the Japanese bond yield, just as a matter of interest here, you can see that this cost of capital for Japan's government has been consistently declining, essentially for, you could probably say something like 15 years, down to below zero. and now it's shifting upwards, and it's starting to concern markets in terms of where they basically get to. But again, I don't think that this is something for the near term, but it's something that we'll have to have on the radar screen probably for some time to come. So we shift a little bit closer to home. As a South African income investor, in terms of our options, you can see South African bond yields now trading well above 11%. In fact, it already traded above 12. If you strip out the COVID spike in March 2020, our bond yields are trading at essentially 20-year highs. And so the question is this just a great opportunity that the markets are mispricing South Africa? Or is this a value trap where we're also on a slippery slope? Bond yields globally are going up. If you look at the US, for example, they're sitting at 10-year highs as far as their bond yields are concerned. So certainly from an income perspective, whether you look locally or whether you look globally, you are in a position here where your access to higher income levels is certainly confirmed. And so from that perspective, I won't say it's a great time to be an income investor, but certainly it's a better time to be an income investor. The question we would have then would be this: is there events that are out there which can, essentially lead to further rises in bond yields, or have we repriced in this macro transition, the post-COVID return to some new normal, if I can put it like that, of slightly higher inflation than what we've gotten used to, and hence the requirement for these higher bond yields and higher interest rates. And I think that's really probably where we are getting to. I will say this, is that it probably will require still some volatility around this as we sort of adjust to that new normal, if I can put it like that. Of course, the backdrop to South African bond yields rising has not just been around an inflation story. And in fact, if one thinks about inflation, we had the post-COVID spike, and inflation is back into our target zone. And this was one of the reasons why the SARB essentially didn't hike rates at their last meeting and communicated essentially a sort of, I won't say a dovish story, still wanted to be hawkish, but you are approaching the top end of the cycle. I think the real story around this rise in interest in bond yields in South Africa is this, which is the journey of South Africa from an investment grade destination to sub-investment grade. And again, this is not something which is a South Africa idiosyncratic story. It's actually something which we've seen amongst a number of different emerging markets. So if you look at South Africa, Mexico, Brazil as a sort of peer group emerging markets, you can see the journey over the last 20 years from sub-investment grade, which was sort of post 94 democratic elections, through to investment grade, by sort of the global financial crisis, and then that journey downwards. And you can see by comparison, Brazil followed very much a similar trend, from sub-investment grade up to investment grade and then back down into sub-investment grade. Whereas Mexico has managed to be able to stay at investment grade. And you can see the result of that is sitting at the bottom, which is our bond yields, 11.75% for ourselves, Mexico at 9%, Brazil at close to 11%. So again, there's this question as to, we know the South African idiosyncratic story. Is our bond yields at 11 or close to 12%, by comparison to Brazil close to 11, with the same credit rating? Is the question would be, why is there such a significant difference in these bond yields? And is it perhaps a situation where what's priced into the South African bond market is probably excessive in terms of that? And by comparison, if I compare South Africa to Brazil over time, this is the difference between the South African bond and the Brazilian bond, or actually Brazil minus South Africa. Generally speaking, because our rating has been better, because it's been better, you would tend to expect to see Brazil's bonds trading higher than ours. And that's reflected in this chart on the left, 2011, 2012, all the way through. You can see the spread was positive, reaching in 2015 a peak of almost 8% differential between Brazil and South Africa, to where we are today on the right, the lower right. You can see that the spread is now negative, which is Brazil trades below South Africa. And this tells the story of our fiscal slippage. It tells the story of our political choices that we've made. But what it does say is, the tendency as investors is always to extrapolate the bad news and to think that it keeps going, it keeps going. I'm not saying that we shouldn't extrapolate, But again, I think, what we have to be able to do is we look at what the bad news is. A lot of it has come over the last year. That we can talk about some of those as well. But again, I think the point that could be made here is that there's a lot of bad news embedded in the price of South African bonds relative to our emerging market peers. And bear in mind, Brazil is a country which has defaulted on its bonds in the past. So, from a fiscal responsibility perspective, I think by and large, it would not be amiss to say that South Africa has been better managed through the turmoil over the last 20, 30 years. And so from that track record, I suppose the question mark would be, are things changing in South Africa to such an extent that we are slipping further and that we are destined to be downgraded even further? I think the rating agencies at the moment have a stable outlook on our rating. So I think from their perspective, yes, there's a lot of bad news. And in that sort of muddle through type of environment in South Africa, we expect more of the same. Muddle through is really what we're talking about here. So if we put all of these together, there's a number of factors that we can sort of extract out of this that inform our views around the markets. Number one is I spoke about those macro transitions, which requires higher risk premiums. There's that recession risk that is hanging over us, in particular in the US, coming from higher interest rates. That's really what higher rates are supposed to do. We've got these black swan risks at the peak of the rate cycle. We know that South Africa specific, we have some of the issues. We can talk about our credit rating, as I have spoken about, the grey listing, our load shedding woes, the corruption. We know there's a whole list of these things. And then there's this inflation story, which was a negative and has become more positive, given the fact that we now are in the range. And we probably will see a SARB in particular by the end of the year starting to talk about and communicate a transition into potentially a lower interest rate environment. And then on the right-hand side, I won't go through all the detail here, but ultimately, what does all of that mean in terms of positioning as an income investor? At the peak of the cycle, we know it's a dangerous time. You want to be able to lock in those rates as long as you possibly can, but at the same time, you want to focus on quality and liquidity, because there could still be black swan events, and hence the ability to shift if required, if there's a significant shift upwards. Again, I emphasize here that we're not saying here that from these cheap levels in South African bonds that we're about to enter into a new bull market. I put at the bottom there, no new bull market yet. Maybe this time next year, we could talk about, some of these factors that we've got around South Africa might start dissipating post our election. But I think between now and then, in particular, we have a lot of event risk, which probably is sort of more to the upside than to the downside, which is, if I use, for example, one of the event risks that we had was around the BRICS summit. And we know what that represented, which was if Vladimir Putin was supposed to come to South Africa in person as a member of the global courts, we were supposed to have arrested him. In the end, we sort of dodged that bullet by basically saying he's not coming. Did the market rally on that news? No. I think this is the point here, is that the event risks don't signify, if they don't happen, it doesn't mean we're going to have a bull market. It just means the market doesn't sell off. So I think if I then start putting this together in terms of, what do we get out of an environment like that? How do we position? What do we do in terms of managing a fund? So if I think about an income investor, what you want is inflation beating returns. You want lower volatility. You want income levels to be fairly high and for as long as possible. And you also, importantly, want to know what that risk budget is in order to accomplish these sorts of things. So again, are you taking, for example, equity risk in an income fund or not? And I think I've highlighted there, you can go and look at the Citywire press release from this morning around the high yield fund rating, about being transparent about your risk budget. What risks are you taking in the bond market in order to deliver those three sort of requirements around, those income levels, basically. So I think that's essentially where we're positioning that. So in terms of our solutions, Again, in particular, I'm going to highlight the high yield fund and the flexible income fund, two very different funds, but they're very complementary in terms of the cycle. High yield fund, for example, won the Raging Bull Award at the end of last year. Flexible income fund has won a number of Raging Bull awards through time as well. And again, through the cycle, these funds perform differently depending on where we are in the cycle. And I think, importantly, and Martin touched on it as well, is that the team that we have has been in a growth journey. We've added 2 new people fairly recently into the investment team, and in particular in the credit risk space. Ringatani and Glovu, for example, has joined us as head of credit risk. So again, even in this, as we're going through this, solidifying the team in order to deliver performance through the cycle. If I just highlight these 2 funds then. The flexible income fund really targets bond-like returns. So if you think about that volatility around the bond market versus the STEFI or the low volatility space in income, the flexible income fund delivers bond-like returns. So that, remember, the all bond index had volatility of, over the period that I was looking, around about a 10-15 year period, volatility has been somewhere around about 6% odd. But this fund can use all the risk levers. It can use credit risk, it can use duration, it can use term risk, and it can use inflation linkers. It can go to money market, it can go to bonds. So it's called the flexible income fund for a reason, I suppose. The high yield fund is different. It's low volatility. So if you think about that STEFI type index, it's targeting that sort of end of the market. It's got monthly income, whereas Flex is a quarterly income, and it only has floating rate exposure. So immediately you can see the way these 2 funds complement each other. If you're in the low volatility space, high yield fund is your income solution. If you're looking through the cycle and you can ride through that annualized 6% type volatility, you will through the cycle get higher returns then through the flexible income fund. And importantly then, if you think about where we are in the interest rate cycle, as rates have been hiked over the last couple of years, as a floating rate exposure, the high yield fund has benefited from that. So it's got low volatility, and every time the SARB hikes rates, the yield on the fund just pops upwards. Whereas in the case of the flexible income fund, because it's not focusing on the money market space, it's focusing on bond returns, which has that volatility through time, doesn't benefit directly from the SARB hiking rates, or as much, if I can put it like that, basically. But again, through the cycle, you'd expect Flex then to deliver greater returns. So when bond markets, bond yields are falling and you're getting capital gains, you'll see the gains in the flexible income fund. You're not going to get capital gain coming out of the high yield fund. So I think that's the important distinction between these 2. So if you look at what we're doing here in the flexible income fund, you can see in terms of this volatility, and this is a shorter period of volatility, and you look at the volatility of the all bond index over this period, you can see it was around about 7%, a little bit more volatile more recently. Whereas the volatility on flexible income fund is probably about half of that on the bottom axis. And then the returns you can see is similar, but importantly, we've been able to outperform the all bond index. So bond-like returns with lower volatility, this is what we're trying to accomplish in this fund. Again, if you look through a number of periods, you can see the dark bar being the flexible income fund, and you can see the gray bar being the all bond index, slightly behind the all bond index on the 1 year basis. Again, bond yields have been essentially rising, so it's been quite a tough environment to operate in. And again, I think, through the cycle, though, we'd expect to outperform slightly. But what we're not trying to do is hit the ball out of the park here. Again, the risks we take must be considered and balanced in order to be able to deliver a solution. And then, of course, we know it is a competitive world out there. And if we look at not competing funds, but the different income funds that are out there, there's 2 groups. The one is the low vol funds, similar to high yield. And then you've got your bond type funds on the right, which is sort of very similar in volatility to the all bond index. And again, where we position ourselves is because we are a flexible fund and able to use duration very actively. So there are times we want to be shorter duration, times we want to be high duration, times we want to use inflation linkers, other times not. We end up being somewhat of a hybrid. And you can see we sort of end up somewhere between, and very competitive as far as the returns are concerned. So again, in terms of that positioning, is we are very active in this fund in terms of the positioning and utilizing all those levers of risk. In particular, duration is always the most important one. if you get the duration call right, you can add substantial return relative to, for example, money market type funds. And you can see through time, these bars essentially illustrate the level of duration of the fund in the bars, and then the blue line on the top is the all bond index. So you can see consistently this fund has a significantly lower duration than the all bond index, and that translates straight through to the volatility of the fund. So as I said, a bond-like return by using all these different levers, duration being one of them, but the volatility measure being duration shows you that we are going to do so with a significantly lower volatility. So what are those levers? This speaks to the strategies within the fund. So you'll see that on the right-hand side, 3 years ago, the strategy within the fund was focused on the yield. That was the low interest rate environment. So it was that search for yield type environment. It was appropriate for the time. But as the rate cycle changed and as we started moving upwards in interest rates as a result of inflation, you can see on the very left where we were in June of this year, ultimately a big focus on duration because bond yields are higher. So again, we can sort of harvest that higher yield. And then there's still a yield component, and then there's a low volatility component to the fund as well. And so, what we illustrate here is the active nature of this fund through time and through the investment cycle. If I look at the credit ratings of the fund, again, if you think about what I was positioning earlier around, higher at the peak of the interest rate cycle, it's the time when the cracks start showing in various forms of the market, and we don't know where those cracks then eventually break. So what you want to be able to do as an income investor is take a more considered approach, which is cognizant of that risk in particular being higher at this point in the cycle. And what that translates into, if you look at the right-hand side of 3 years ago versus where we are today, the AAA rated component of the fund significantly higher at today. And the reason for that really is the investment environment today, essentially with the higher yields, means I don't need to go further down that risk spectrum, in the credit risk spectrum, in order to add significant yield into the fund. So it's about getting that balance right. And then liquidity risk as well is, again, if we're going into an environment at this peak of the cycle where there could be black swan events, maybe there isn't. But again, the point would be that the ability to shift your strategy, if something were to happen in the market, is also an important consideration in the way that we manage the fund. You can see at the bottom there, what we're saying is taking the appropriate risk at the appropriate time. And in particular, what we're trying to do here is we've essentially reduced liquidity risk, or we've improved the liquidity profile of the assets in the fund. If you look at, for example, the predominant component of the funds, with that yield focus 3 years ago, was sitting in credit assets, which traded less, versus today, where we haven't got as much of a focus on the credit space and more focused on the pure government bond market, which is significantly more liquid. That enables us to shift our strategy if there were to be something in the market that required us to shift. Okay, so the high yield fund, again, I think if one looks at the sort of the profile of this fund, if you look at the all bond index in the blue, and then the dark line is the high yield fund, it really tells the story of the low volatility nature of this fund. There really has only been one sort of blip on the fund, and that was at the time of COVID. And again, the assets that the fund was exposed to at that point in time, in particular, second tier assets from banks, those spreads blew out. There was worries about the economy coming to a standstill. Banks would essentially see massive defaults. That never happened. But at the time, we saw those spreads being marked to market, and we saw then sort of, subsequent to that, the market recovery, and there has been no volatility in the fund subsequent to that. And again, this is through all sorts of volatility, which we've sort of highlighted. I won't go through all of the detail of that, but really to sort of position this fund in terms of that low volatility space. So certainly, if you look at the similar risk return profile here relative to its sector that it operates in terms of the interest-bearing short-term funds, you can see all of the funds are pretty much low volatility. If you look at that scale on the bottom, and then the returns we've been able to deliver as a floating rate fund, moving upwards as the SARBs hike rates, you can see that it's delivered a very, very competitive return with that very low volatility in the fund. And then if I just sort of highlight, I've said that Flex was a bond-like returns with low volatility. What we're trying to do here is focus on the income, its monthly income, and its low capital volatility. That's the investment objective of this fund. And it's a floating rate focus, you can see on the right, basically. So if you look at the performance of the fund, again, if I compare it then to that Steffi composite in the gray, the dark bar being the fund. You can see through time, this fund has been able to deliver, whether it's short periods or whether it's longer periods, or since inception over the last 4 and a bit years, it's been able to consistently outperform that money market space. So that is essentially the way that we would position it. So just to highlight the differences between the flexible income fund and the high yield fund, you can see that the floating rate component of the high yield fund, that those two middle bars, over 86% of the fund sitting in floating rate, with some money market sitting in the less than 1 year component on the right. And you can see that flexible income fund being the darker bars, it has got a floating rate component, but it's predominantly focused, given where bond yields are on the fixed rate side of things. It has had some linker exposure, but we pretty much sort of started exiting from that space, and then a little bit of money market as well. So you can see there is an overlap, and they're complementary funds, but they have two very distinct investment objectives. Not to say either of them is any better than the other. It depends on what your risk mandate or your risk appetite would be, and how you want to position yourself as far as volatility is concerned. So you can see the weighted average yield of high yield is sitting around about 9.7. In the case of duration, you can see, which is that measure of volatility, 0.1. It'll pretty much very seldom be anywhere closer to sort of 0.5, even in an extreme. And you can see that sort of the most recent number, 88% sitting in floating rate, as at the end of June, I think it is. Or in fact, I think that's probably more closer to the end of July. So I think, again, from that perspective, if I highlight then the levers that we take within the fund as well, similar strategies in terms of exposure to the credit space as far as a lever of return is concerned. So as you know, as you saw in the flex, focus on yield, a lower tier exposure. You can see now where we are at the moment, given where we are in the interest rate cycle, much more exposure into the top end of the market, the AAA spaces. And then similarly, if I look at the liquidity story as well, again, a shift away from the credit assets, which is less tradable, towards more tradable assets. You can see the predominant component sitting in the 3 to 7 day component of the high yield fund. So again, you can see the overlap as far as the strategic positioning is concerned, but they have different approaches in order to accomplish the different risk mandates within that income space. So if I think about putting all of this together, where do we expect to see returns go to? In the case of Flex, what we're looking for here is that over the next 12 months, we expect to see returns in the bond space probably between 10 to 13, and for this fund would probably then be able to deliver 11 to 12%. And I said more if inflation and South Africa behaves, in the sense of if you see bond yields falling 50 or 100 basis points over the next 12 months, then you could see returns even getting closer to 13, 14%. But I'm not going to build any expectation around that. I think our core expectation is around about 11 to 12 in this, and that does not require the market from its current elevated bond yields to be in a bull market. All it's got to do is just harvest the running yield, and you'll deliver a return here, which will, in our sense, the way that we position things, it'll be lower than the volatility of the all bond index over the course of the next 12 months. High yield, of course, being a floating rate asset, is going to be directly linked to what the SARB does. So if the SARB, we expect over the next 12 months that they would have started a rate cutting cycle. But if they have to cut rates dramatically for whatever reason, if there's a recession or a deep recession or some other black swan event that the SARB has to cut rates, there's a direct correlation between what the SARB does and what you see on the high yield fund. Obviously, what we would try to do is we would try to lock in yields if we saw this coming for as long as we possibly could. And there's ways and means that we can do this using structures in order to accomplish a sort of a longer income yield over time. But again, I think that's really where the positioning between these two funds is concerned. And I think what I will do is I've left some time open for questions. I think that is my last slide, yes. So I think I'm going to park it there, and then happy to maybe hand over to Martin if you want to maybe facilitate any questions, Mart.
Thanks, Arno. Yeah, we've answered a couple in the chat already. I don't know if there's any other questions. If anybody would just like to maybe just write those in the chat, We'll give a few minutes for some questions, and Arno can deal with those.
Okay, do you participate in any green bonds? Mark, no, not directly. We have looked at them. Typically, the sorts of yield pickup that you get from them hasn't been substantial. And as you saw in those sort of charts that I showed in terms of our strategy, it has shifted away from credit, because the sort of the yield pickup has really sort of been not substantial. And our view has been that credit spreads in South Africa actually are probably too low. I actually sort of saw, I mentioned Ringatani earlier, that joined, she actually put together an overview of the credit space, and she had one very interesting chart, which I didn't include here, but it's essentially the probability of default index. And the probability of default index has been rising, and credit spreads have been going down. And it's all it is about the search for yield in a South African market in terms of supply and demand. But no, we haven't participated in the green bonds directly. Dave Elliott, your question, what is your inflation expectation? I think for the South African story, certainly what the forecasts are showing at this stage is that inflation is reasonably contained in South Africa. I know it sounds, when you look at prices around you, you always sort of say it's not 5.5%. And depends on, if you've got children going to school, and your cost of education is probably significantly higher, these sorts of things. But overall, I mean, the basket expectations are that it's stabilized below 6%. Even the SARB's forecasts show that over the course of the next 2 years, inflation will decline closer towards the 4.5% level in South Africa. Again, I think, from that perspective, that's, all else being equal, right? No new shocks. Rand doesn't blow out, oil prices don't blow out. All those sorts of things are there. But I think, I think the context for South Africa in particular is that, we are a low growth country. And certainly it's very hard for corporates to pass on price increases. It's hard for them to do that. And so certainly where you sort of see that is margins being squeezed. So it's a very different story in the case of the US, for example, where the economy is doing exceptionally well. It's easier for them to pass on some of those price increases. And the one big driver of inflation in the US has been the housing element for various structural reasons. And that's probably one of the reasons why the Fed is still sitting in a hawkish space. So hopefully that answers that question. Howard, your question on duration, I would presume, again, in the case of the flexible income fund, where that would be. So I showed that chart where we are at the moment, around about 2.6 in duration, and all bond index sitting just below 6. So around about half that of the all bond index. So duration, remember, is a measure of volatility. The way that the rule of thumb would be something like this: if the duration was 3, for example, and bond yields fell by 1%, then the duration of 3 would mean you'd make a capital gain of 3%. Of course, the other end of that coin would be if bond yields rose by 1%, you'd make a capital loss of 3%. But remember, you're getting income of around about 10% at the moment. So it would be 10 minus 3 or 10 plus 3 would give you a range. So that's really sort of where we positioned. And what we generally do in terms of the range that we would work, it probably somewhere closer to 1.5 at the bottom end. If we really sort of had a massive rally and we sort of said we want to be short duration, probably closer to 1.5-ish. And then on the upper end, I think for the last 6 odd years, the top end of the range as far as duration is concerned was probably in the region of just above 3. So that's really been the range. It's quite narrow. What we really try to do is, you don't want to have one single strategy driving performance in the fund. So what you want, as I showed those different strategies, whether it's the roll down effect, whether it's a low volatility strategy, or whether it's credit, you want to be an active manager using those different, as I call them, levers of risk in different times within the cycle. Hopefully that's the sort of where you wanted to get to in terms of duration is concerned. Right. Oh, okay. Sorry, I'm scrolling down. Don't understand the term. I hope, Howard, that explains it. It's a measure. Longer duration assets are really assets that have essentially the cash flows that come out of a bond. The predominant component sits in, let's call it, further out in time. And because of that, as yields change, if you do a discounted cash flow on that, the value is going to be changing quite a lot. Whereas if you've got a short term, if bond yields change, it's not going to change very much, like a money market asset. You can see that's why a money market fund has no volatility. Right, Kyle, one question. I don't know what the question is. Was a great presentation. Okay. Amelia, thank you. No more questions. Okay.
Oh, no, I think, yeah, you got the question. Okay.
Yeah, I got it up. Sorry, I'm just scrolling down now. Thoughts on corporate bond outlook. I hope I touched on it. I mentioned Ringy's outlook, or that chart, for example. We think that bond yields are probably not pricing in sufficient risk. If you just think about corporate South Africa, and we know that the environment that we're operating in is a constrained one. We know the energy story is constraining growth. So, it's a simple matter of you at the peak of the interest rate cycle. We know consumers are under stress. So, for us, taking on that risk really is, it should come with a commensurate return. And we just think that the return you're getting is not recording you compensating you for that sort of risk, basically. And remember, bond yields are at 20-year highs. I'm not going to try from a 12% yield when inflation is below 6. I'm already getting a 6% real yield here. Why do I need to go and try and invest in an Eskom bond giving me 13% and take on the risk around Eskom and all the uncertainties around that? So that's where we're coming from in this space. It's not to say that forever and a day, you must never touch credit. All I'm just saying is it must be appropriate for the time that we're in at the moment. Okay. Takaraj, in general, governments, central banks not making the debt problem worse by kicking the can down the road. Yes. If you go and look at the history of defaults, and if you look at in Argentina, for example, they've had a number of defaults. And it's essentially many of these countries that default, what typically happens is that they have significant foreign currency debt. So what happens is when you start having issues in your country and your currency blows out, the value of that debt just goes, it balloons. And that's generally why when countries default, then they default first on their foreign currency debt. It's interesting because South Africa has actually, by comparison to our peers, had significantly lower foreign currency debt in dollars and euros, basically. But I agree, certainly, it is kicking the can down the road, and it is an approach which buys you some time, but it comes down to the cost of the debt. So markets, you can't fool markets because eventually down the road, and if you think about South Africa, where our bond yields have been rising, and looking at the credit rating sort of downgrades, is that we've kicked out sort of problems down the road, and we're slipping, and the cost of the debt's getting worse and worse. So what eventually happens is that quite a significant choice has to be made. At some point, you get to a crossroads. Either you're going to go the austerity route of cutting back in a government financing perspective, or you're going to have to start essentially using inflation in order to inflate away your debt problem. And that's always the dangerous environment that we have. The view of a threat of South African sovereign default, I don't think that is something which we need to worry about in the near term. I think we still have significant access to if we really were sort of getting sort of desperate, foreign withdrawal from our bond market. I think there is a difference between foreigners investing in our local market versus South African government issuing debt offshore in dollar terms. So if you think about a foreign investor, if they're investing in our bond market here, they are getting a rand asset. And a lot of those investors don't want to have exposure to the rand because for all the reasons we know, it's one of the most volatile currencies in the world. So your asset is also volatile. Whereas if South African government issues a dollar bond or a euro bond, it's in dollars. So they don't have to worry about currency risk side of things. But I don't think that we need to, it's not something we need to worry about in the near term. I think there are obviously, anytime there's going to be any defaults around the world, there are some flags, and lack of access to funding. So in other words, if South Africa couldn't issue bonds offshore, that sort of thing, it would, you'd start to see that. And we haven't seen any sign of that yet. The ESG drive in the fund, I wouldn't say that there's a specific ESG drive within the fund. Obviously, what happens is when we look at any credit around the fund that we use, so in other words, non-government bonds, for example, where we're taking on that, we look at, essentially the underlying company, whether it's a corporate, if it's a bank, for example, or whether it's an SOE, for example. And one of the reasons why we've been, in fact, reducing exposure into SOEs over the past number of years to below even 10% is precisely for this governance issue, the ESG, and it's the G component around that. So certainly it's a factor that we would sort of look at when we sort of trying to decide how we invest. How do you measure your liquidity profile? Are the bonds held for that time or matures in that time? Okay, no, it's an easy one, Rushil. So the way that we do this is we look at every single asset in the fund at any point in time, and we then look at the JSE, and we sort of say, what's the average volume traded for that asset? So let's just say, I'll just give you a hypothetical example. Let's just say there's a bond that we hold, we've got 100 million of it. The daily average volume traded, I'm going to use hypothetical, is 10 million rand, right? Then it means it would take 10 days to liquidate that asset, 100 divided by 10. And we do this for every single asset. And that's how we get, and then we weight it. So if the 100 million was 10% of our fund, then we would weight it appropriately. That's where we get to those buckets, basically. So it's just a measure of how quickly you could actually liquidate the fund. Are you concerned about liquidity? I'm not concerned about it necessarily in terms of recession or potential recession. It's around, so remember, we are taking certain risk, and we're generating a return based on that, as I've shown in those strategies. And then what we're saying is it's a dangerous period in the market around the peak of the interest rate cycle. We don't know what those black swan events are. Is it Japan suddenly going from a 0.5% bond yield to a 3%? Which would be, a really big shift, and then there's some contagion potentially. And how would we need to respond? Would we then have to cut duration to 0, go significantly lower? That's the liquidity issue, and the way we're trying to position the fund. And remember, by having that fixed rate exposure of 11.5%, 12% within the fund, I'm not sacrificing anything here. All I'm doing is I'm just saying the assets I'm going to hold, they are high yielding relative to the past, and they're giving me a fantastic real return, and they're very liquid. So it's like sort of a, I'm not going to use the word no-brainer. There's nothing like that. And then, Sumaya, you ask, do both funds hold any foreign exposure or property, as some of the peers do? There's no property within the fund. We don't ever hold that. Foreign exposure, we do hold some foreign South African government bonds, which we then bring back into rand terms. So I don't ever have currency risk. So there is some exposure. And the reason why we do that is because when South African government issues offshore bonds in the dollar market or the euro markets, there's a sort of almost an arbitrage in a sense, which it has to have almost a bit of a higher yield for that risk of a default in foreign currency terms. But when you bring it back into rand terms, it actually then gives you a higher yield, even though the underlying issuer, being SA government, is the same. So I think that probably answers that question.
Right, thanks, Arno. I think that's it. Thank you, everybody, for joining us. There were a couple of questions again. We will be distributing the slides to all the participants. If there's any other questions, please feel free to contact us directly. Thank you very much, Arno, and thank you, everybody, for joining, and enjoy the day off tomorrow.